Hello and welcome to Policy Bazaar. I'm Arjun Bhagat. Now, as grown-ups, we understand the importance of money, but what about young adults who have just started earning? I remember when I first started earning, my first choice was spending. Then came the credit cards and then spending whatever else was left over. Savings in the initial stages of our work life is never really a priority for most, but as the wise will tell you, the earlier you start saving, the quicker you will reach that financial sweet spot. So how should one plan and invest for a solid financial future? To help us plan and invest wisely, we have Yashish Dahiya with us, co-founder and CEO of Policy Bazaar. Welcome to the show, Yashish. For a person who's 25 or thereabout, why is investing so important? Because that's the last of the priorities, really.
I think one of the reasons it's the last of the priorities at that age is that people believe that, the amount they will be able to invest will be very small. It may be 1,000 rupees, maybe 2,000 rupees, maybe 5,000 rupees, because their salaries, they're just starting out in their careers and their salaries are relatively less compared to the more, grown-up people, at least the people who are in their 35s, 40s, etc.
That's when you start having families.
That's when you start having a bit more of
seriousness.
And so somebody thinks, what will I gain by kind of investing this $1,000? At least let me create some kind of a corpus and then start investing. And I think that is exactly the thought which holds people back from investing quite a bit. And just to clarify this, if you just take a perspective of a 25-year-old from a financial angle, if they invest, let's say 2,500 rupees every month for their entire career, and they start investing when they're 25.
What you're saying is 2,500 rupees a month.
2,500 rupees a month. That's it. And they suppose they'd been doing this for the last, when they were 25. Suppose when any of us was 25, we had started doing this, and suppose by the time we turned 65, which is the day when you would retire, that corpus that you would have built up, if you were just investing in any equity market in India over the last 30, 40 years, would be roughly about 3 to 4 crore rupees.
Wow.
And
that's just out of 2,500
that's out of 2,500 rupees over a 40-year period. That's exactly what it does. That money, if you put it in a bank and just earn the interest out of it, would give you an interest of about 2.5 lakh rupees every month. So by investing over a 40-year period, you can have almost 100 times the amount coming back to you as a monthly interest. And we don't think about this. We think that, what is the point of investing 2,500 rupees? We all do that. None of us goes and invests 225. And that's the power of continuous investment and the power of compounding over a long period of time. And that is the power that the 25-year-old only has, because if the 35-year-old starts investing, that person investing 2,500 rupees will only end up with roughly about 1 crore, which is also a large sum of money. So a 35-year-old doesn't need to give up on that, but that is the power that one has when one is 25, that if they start, that extra 10 years can give them 3 times the amount of corpus.
So Yashish, what you're saying is that even a basic 2,500 rupee investment goes a long way if you invest systematically and over a long period of time.
Absolutely. And just to put this perspective, which I just spoke about, the 25-year versus the 35-year-old, suppose one is 25 and they start investing this 2,500 rupees on a monthly basis. Over the next 10 years, they do that. Now, that's 120 months. So 120 into 2,500 is roughly about 3 lakh rupees. I'm not included any interest. You put some interest together, money will usually double over this 10-year period. So it will become about 6 lakh rupees. Now, what is the interest that anybody from any bank can earn on 6 lakh rupees in the bank? You would come up with an answer of about 5,000 rupees.
Right.
So now comes the interesting part. So now you are 35 years old. You've been doing this for the last 10 years. Now 5,000 rupees is getting deposited from the money that you've already collected every month into your account. So if you start when you're 35, you are only investing 2,500.
Right.
So you've got 3 times the money. And this is the answer, that by the time you're 65, you will have 3 times the money if you started at 25 than if you started at 35. So the initial 10 years is very, very powerful in any kind of long-term investment. And that is precisely why this power only belongs to the 25-year-old, not to the 35-year-old.
Okay. Excellent advice. It's pretty mind-blowing, actually. All right, so how should a 25-year-old go about defining financial goals and investing? I mean, what is the plan that you would give them?
I think they, it's not a very morose thought. One doesn't need to start really getting worried about pensions because there's a long way off, and it may come. Fortunately will come, hopefully will come. And I think there's lots of things that a person will go through, and every 5 years you should reassess where you are. But I think as an individual gets married, as they have kids, as the kids go to college, your financial situation, your ability to earn more than your costs keeps changing. And of course, you need to reassess your situation every 5 years, and there will of course come a time when you would retire. But given what I've just said, that the power of compounding over a long period, I think whatever they can invest, they should start investing. Now, one simple rule of doing so is, when the monthly check comes home, they should start counting their salary as salary minus that investment they're going to make. They shouldn't think too much about what the amount is going to become. They should just start making that investment. And they should, given such a long period of time, they should usually invest into the markets. So whether they do that through something like a low-cost ULIP, or whether they do that through a mutual fund route. The reason I mention this, and this is a very important point, and most people, 99% of people, including the people that work in our own organization, when I speak to them, they do not get this. They still see, but the markets have got risk. The markets have risk for a short period of time, less than 5 years, less than 10 years. There has never been a period in our history in the last 35 years when over any 10-year period, the market has given less than a 13% return. So the markets will give you a decent return always. It's not risky. And I think over a 40-year period, there is no way that the market can give you less than what the fixed deposits will give you. So certainly I would hope that people can invest into the market, and they can invest on a continuous basis. I think these two pieces, and after a period of 5 years, maybe they're getting married, maybe they've moved ahead in their life and they've had some kids. That is a time perhaps to reassess once more.
Because that question always comes, oh, where will I get that extra 2,500? I've got so many, I have to go party with my friends and also. Where does he or she squeeze that extra bit about? I mean, how would you convince them to do it? Though what you said was very convincing, that 2,500.
I think one has to believe one's going to live a long life, and ups and downs will come. And I think in those situations, you would find yourself very, very comfortable. So what I would advise most people is put about 12% of your income into some form of long-term corpus growth investment when you're about 25. So if somebody has a salary of 20,000 rupees, they're putting about 2,500 rupees or 2,400 rupees. And that doesn't seem like a big ask, because if you have a 20,000 salary and you can do with a 20,000 salary, I'm sure you can also do with a 17,500 salary. Maybe there's some expense that can be cut out. Maybe it's that, instead of having drinks with your friends 3 times in a month, maybe you can do that 2 times in a month. Maybe, instead of buying a very expensive car, you can take a slightly less expensive car. Your social standing will not drop just because you have a slightly smaller car. So I think a lot of those costs that come in, see, the cost is only available after the saving. If you make that a rule, the opposite is you say, okay, I've got all these costs and then whatever's left is my saving. I think the better mechanism is you put the saving first and basically assume. So
look at it as part of the total cost of your lifestyle.
The second thing, which I would advise is, and a lot of people fall into this trap, do not be very credit easy. So specifically if you've got credit cards, do not allow them to go into overpayments or rollovers. Just make sure that you pay on time. I think credit cards have one of the highest interest rates, and if you have debts, try to consolidate them into a single personal loan or something. So if you have 3-4 credit cards, try to consolidate them into a single personal loan. But usually try to avoid those, because these instruments like credit cards or personal loans will always cost you more than what the bank is willing to give you for interest. And over time, what I just explained, the power of compounding, that can also start working against you if you fall on the wrong side.
So you can really get into debt.
You can get into debt big time, and then it becomes very messy to get out of it. And it makes debt more and more expensive for you, because you will just keep going down that trap. So that is, I've seen some young people, the salary is quite small, but taking large loans for expensive cars or for an expensive honeymoon, or I know it's a once in a lifetime thing, but
even houses. I mean, a lot of people take huge amount of EMIs.
Houses, because there is property appreciation.
Right. So it makes sense.
It may make sense, because property appreciation is usually keeping up with the interest rates on houses. So plus you get the tax benefit. So there's a bit of advantage in the house side. So that is one piece which I would advise.
Now let's move to insurance. Now, how important is insurance for a 25-year-old, and how should they decide that, okay, this is the right amount to invest in insurance? You know, different plans that we have.
I think a couple of types of insurance make a lot of sense. I think, see, the most accidents in the world happen to 25, unfortunately, to young people. You rarely hear of a very old person having a road accident. It's usually younger people who have the road accidents. So I think a personal accident cover is really called for, because that can set life back quite badly. And I think having a good, at least financially, not being bad off because of the worse off because of the accident will really help. And personal accident covers don't cost so much. So a 10 lakh personal accident cover probably costs 1,000 rupees a year, which is less than 100 rupees a month. So that's one part. I think second is health insurance. Health insurance, even if your company has a health insurance cover, please go for a top-up cover. Top-up covers are basically, if your company is providing a 3 lakh rupee cover, you can take a cover, you can enhance your cover from 3 lakhs to 10 lakhs using a top-up cover. And those come at a fraction of the price. Because the chance that you will go above 3 lakhs is very low. See, insurance is about those events which have a low probability but a high impact. So the chance that you'll go above 3 lakhs is very low, but if it does go, then that cover takes care of it. So super top-up covers really help. And the base health cover also helps. You do not need to take a life cover. You genuinely do not need to invest in any insurance cum investment plan, with the one exception, which are low-cost ULIPs. And I mentioned that for a very specific reason. It is uncanny, but low-cost ULIPs today are cheaper than most equity mutual funds. See, most equity mutual funds will work at a cost of about 2.5%. 2 to 2.5%.
Right.
Whereas a low-cost ULIP, or any ULIP, cannot be more than 2.25%, and low-cost ULIPs can even go below 1% as a total in-place cost. So those have become very strong instruments that you can start investing in early, and over time they will give you a very good return. So I think, as I said, health insurance, personal accident, critical illness, maybe when you're a little older, because most people do not get a critical illness that early.
So but we were talking about financial planning. We were talking about the insurance covers that a 25-year-old needs. Can you quickly recap that for us, Yashish, before we take consumer questions?
Basic health cover, basic health insurance, maybe a top-up cover if you have a company cover. I think the third piece would be a personal accident cover, because personal accidents do happen, and I think getting covered for that is very important. And the fourth thing could be a low-cost ULIP. It obviously supports you in your tax planning, but also over the long period, it will give you very good returns and at a very low cost. So it can be a very good investment in the long run. So those are the four plans I would mention. I have not mentioned specifically, because it's also important to know what not to buy. You do not need a life cover at this stage till you're married. Once you're married, you need a life cover, because who would get the benefit of the life cover in the unfortunate event that does come in. And from a critical illness, I'm not advising it yet, because I think one should maybe start buying critical illness covers after about 35 or so, because that's when some of these, although recent studies have said that heart disease is really setting in between 25
yes,
to
I've been reading
40-year-olds. And that's a very worrying trend, because it's specifically happening in India, where 25 to 40-year-old is the age in which the heart disease is increasing the fastest. So if you think that your lifestyle is such that you could fall susceptible, although I've seen all kinds of people falling susceptible, so then probably a critical illness cover is very called for.
So you need that overall umbrella to protect you.
Absolutely.
And then
Absolutely.
life can go on.
Then life goes on, yeah, and
happily. And
this needs to be done. One day, spend a few hours and complete it. And my advice is that do not take, including mine, anybody's advice. Please go and do it yourself. Or if you take advice, take it from 3-4 people, but then finally go and buy it yourself. Go and buy it online, because I think you will get the best product that way. Whoever advises you will advise you for their own needs, not for you.
Right. Well, we're going to take consumer questions. We've got Sapna Bawa from Roorkee, and she says, I've just bought a Bharti AXA Life Ajivan Sampati plan for my child for 15 years. Is my choice correct? And she's spending about 50,000 rupees a year for the first 5 years, and then 25,000 thereafter.
So I think it's important to understand what is this plan. It's a traditional whole of life plan. What it does is you invest for these 15 years, but from the 11th year onward, you start getting about 5.5% of the basic sum assured every year for the rest of the term of the policy, which is all the way until maturity. Now, while 5.5%, now let me just explain how this plan works, because you would then have a better understanding of whether you should be going for this plan or not. So if you've invested for 10 years, now usually the sum assured of a plan is about 10 times what the amount that you're investing every year usually. So what has happened is you've invested some amount and that capital has built up, and now you're getting 5.5% of that back. That capital stays where it is, and you keep getting this 5.5%, which is pretty much like an interest payment that's going on for life. And in the event of an unfortunate death, that entire corpus is given back. These are usually inheritance plans. And it usually works when bought for a child very early, because the longer the duration, the more is the time that you get this tax-free amount. Now, the important part of this 5.5% is tax-free. So if you get this 5,500 rupees, let's say arguably on 1 lakh rupees, and this 5,500 rupees is actually not equal to 5,500 rupees. It's like 5,500 rupees divided by 0.7 or 0.65 if you are in that tax bracket. So it's almost equivalent to a taxable 8 to 9%. And in that sense, it can make some sense. However, this is not if you want corpus build up to use that money yourself. It's not a great plan. It is a great plan if you're thinking very long term, because it pays out all the way till a person turns 100. So over a long period of time, the individual whom you've bought this plan for will keep receiving these amounts for a very long period of time, and all of us at some point will pass on, and whenever that individual passes on, this amount would then be inherited by their next of kin or their nominee. So that's the power of this plan. If you understand it and if you want to buy it for that purpose, please go ahead.
Right. Well, we've got Sachin Marwandekar from Mumbai. He says, I'm a self-employed. He says he needs travel insurance as he keeps traveling for work. Is there a travel insurance which can cover me for multiple trips abroad? I guess that's what he's asking.
Absolutely. So, for example, I travel quite a bit as well. And, usually what you would do is if you are going to travel once or twice a year, then you take individual trip plans which cover you for the duration of your trip. Otherwise, if you're going to travel more than twice a year, I think the rule of thumb is take the annual cover at that stage. And depending on which part of the world you're traveling to, just try to see if that particular company has a good coverage there. So certain companies have better coverages in Europe, and certain companies may have better coverages in the US. And that would really depend upon who their foreign partner is and who they are tied up with. So how large or how small the companies in India is quite immaterial in a travel insurance, because the coverage will actually be provided abroad. So just get into that a bit. And I think once you have an annual plan, it saves you quite a bit of hassle, and also comes out to be a lot cheaper than buying it on a regular basis. Now, companies cover you for trips, for a trip duration of total trip time of 30 days to, there's some companies that cover you up to 180 days. So you should look at that as well, because suppose you're traveling 4 or 5 times for a 2-week duration, you might be above the 30-day threshold. So buying a 30-day plan may not be the right plan for you. So just go into the total amount of days that you're going to travel for in a year.
And that'll probably work out more cost effective.
The amazing part is the price doesn't change too much. This is odd. So the price doesn't change too much whether you're taking a 30-day cover or a 180-day cover.
So you don't get a wholesale price just because you're traveling more.
So I don't know why the companies have that, but I've checked the prices, and the prices are really not that different. So actually buying a 180-day cover might actually be good for you anyway.
No wholesale kind of a discount. All right, Yashish, that's all the time that we have on this show. Thanks for joining us. But do write to us, ask.policybazaar.com, tweet us at Twitter at policybazaar_in, and we'll see you next time with another episode of Policy Bazaar. Goodbye.